Hello and welcome back to Financial Freedom Hub. In today's video, we're going to talk about how a company can increase its shareholders' wealth, tax-free. We will reveal another secret the world's wealthiest investors use when buying stocks that keep making them even wealthier. Just a little reminder, you might want to check out our other videos on our playlists on how to interpret income statement, balance sheet, and cash flow statement to learn how to easily understand any company's financial statements. In those videos, we reveal all the secrets that financial statements can tell you about a company and its underlying business. Again, this knowledge is used by the world's richest investors and is not taught in schools. We also recommend you to subscribe to our channel so you don't lose it among millions of other great channels. If you're ready, let's get started. As we have discussed in our earlier videos, a company can use the profits that they have earned from their business in a few ways. They can pay dividends to shareholders, they can reinvest the profits in their business, or they can buy back their own shares. While receiving dividends may sound great, this is not the most efficient way to increase shareholders' wealth, because shareholders need to pay taxes on their dividend income. This means that the government takes their share of the profit and reduces the amount of money that could otherwise work in your favor. Secondly, the company can reinvest the profits into their business and put the money into better use in the future. However, when the company does not want to sit on cash, and they can't reinvest in their own business, or they don't find a new business to invest in, they can use the money to buy back their own shares. Now, let's talk about what it means to the company and to its shareholders if a company issues new shares or buys back their own shares. Imagine a company that had 10 million in earnings and has 2 million shares outstanding. In this case, they report earnings per share, EPS, of $5. If the company additionally issued 1 million new shares, the EPS would immediately fall to $3.33 a share. Similarly, imagine that the company bought back 1 million of its own shares. The EPS would increase to $10 a share. What it means is that when a company decides to buy back its own shares, it increases the equity per share and earnings per share, which in turn drives the share price up. The best part is that shareholders have to pay their taxes only when they sell their shares. Now, how do we find out if a company is buying back its own shares? For this, we need to look at the cash flow statement and look under Cash from Investing Activities section. There, we look for the item, issuance or retirement of stock, net. Please be aware that it can be called differently, but you get the idea. What we want to see is the consistent history of share buybacks. If we see that the company in question buys back its own shares year in and year out, it's a strong indicator that the company has some kind of competitive advantage over its competitors. If you'd like to learn more about stock buyback effects on balance sheet, please feel free to check out our video, Treasury Stock. You can find the link in the description. Be sure to leave a comment below if you have any further questions. Don't forget to like this video if you found it helpful, and subscribe to the Financial Freedom Hub for more insightful content. Thank you for watching.